Okay, so one of the most contentious areas of running business, and one that's most fraught with confusion quite often actually, is the taxes that your business is liable for. Some of these things get really sort of swept under the carpet. People don't really think about it when they set up the business, how this is going to impact them, or just the rules around taxes. They just don't always understand them and rely too heavily on their accountant. And what often happens is they get presented with a tax bill they weren't expecting at a time they weren't expecting it, and it causes all kind of problems. So I think, again, in the theme of accountability, which for me is a massive theme around running a business, it is your responsibility to understand the taxes that you're liable to pay as a business. So we're going to go through the most common ones. Obviously, there's loads of different taxes that could apply to your business depending on what you actually do. So again, it is your responsibility to understand all the taxes applicable to your business. We can certainly help you with that if you've got a very niche business that does certain things that aren't covered in this video. Then give us a shout. We'll try and help you with that. But what we're going to cover in this video is the most common business taxes, and then we have separate videos to go through each one of them in isolation. So the first one is the classic that all limited companies have to pay, is corporation tax. So this is essentially, it's a tax based on earnings, as a lot of these taxes are. So if you generate a profit, you'll have to pay corporation tax, unless there's things like R&D tax relief. There's capital allowances on certain types of asset. I'm not going to get into those in massive detail, but we will talk about them in the corporation tax video. But basically, if you make a profit, you will pay corporation tax. It's that simple. If you don't make a profit, then obviously you won't. And not only that, if you make a loss this year, you can carry that loss forward and use it against the profit that you make next year to minimise your tax liabilities. The corporation tax is the simplest of them all. If you make a profit, you'll pay tax. Now, the rate of tax you pay depends on how much profit you make. So up to £50,000, the tax rate was changed April 2023. Prior to that, it was 19% on your profit. After that, it's 19% on profits of up to 50,000, and then it's 25% beyond that. So again, it's not quite that simple, but we'll go into that in more detail in the corporation tax video. There is a sort of point at which it's neither of those amounts, or effectively neither of those amounts. But anyway, we'll worry about that later. So corporation tax, most business owners are aware of this and know all about it because it's one that everybody has to pay. Employers' national insurance. Now, this is sometimes confusing for people because you think of national insurance as a deduction from the employee's pay, and it is. The employee's contribution to national insurance is deducted from their pay, but the employer also has to make a contribution towards national insurance for each employee. Now, there's elements of this that can be confusing, but ultimately, if you're employing people and they earn over a certain amount, then you will have to make a contribution to their national insurance. There is an allowance for most businesses qualify every year. It's called the employment allowance, which gives you some relief against the first. Well, at the moment it's 5,000. That is subject to change. It has changed previously in different tax years, but employers' national insurance is a contribution towards the national insurance of your employee. And it's not a deduction from their pay or anything like that. It is a cost to you. It's literally a cost of employing that person. So it's something that you need to be mindful of when you take on employees, because again, people don't always think about when they're recruiting. And especially in the early days of a business, when it's actually quite an exciting thing to take on your first employee, you don't always think about the cost of employing that person. And this is quite a big one potentially, depending on what they earn and how many employees you have. This can be quite a big bill. So Class 1A national insurance is slightly different. It's still national insurance and it's still a contribution to your employees' national insurance, but this one's slightly different. It relates to benefits in kind. So if you don't know what benefit in kind is, we will do a video on that as well. But ultimately, it is where you pay your employee in some other form of remuneration other than a salary. So obviously if you pay them cash into their bank account, that will go through your payroll system, tax will be calculated and deducted at source, and whatever they end up with, their net pay, that's their pay. However, some employees will also be receiving value and remuneration in some other way. So things like a company car, or medical insurance, or death in service benefit, or actually death in service benefit is an interesting one. So we'll cover that on the Class 1A on the National Insurance independent video. So the point of that is, the point of this whole benefit in kind system really is that it's so that it can't be treated as a tax dodge. You know, in theory, you could give somebody £10,000 a year in salary, and then another £30,000 a year in, Amazon vouchers. And technically, the Amazon vouchers are not salary, even though they can be used like cash. They're not cash, so they wouldn't go through the PAYE, and therefore there'll be no tax deducted. So this is a way of getting around that. You would have to declare that as a benefit in kind. The employee would then have to pay tax on it, and the employer has to pay the Class 1A national insurance that they would have paid if it was paid to the employee as a salary. So that's what that's all about. Another tax, it's not really a tax as such, but it's something that governments are liable to pay in relation to their wage bill, so it's kind of in the same bracket as the two things we're talking about here, is the apprentice levy. Now, we're probably not going to do a separate video on this because it doesn't affect many of our clients, but the apprentice levy is a proportionate contribution to the cost of apprenticeships. So, for example, if you're a small business and you take on an apprentice, you'll get an incentive in many cases. It depends on the age of the apprentice, but you might get an incentive to employ them, and also they get all their again, it depends on the age and the type of qualification stuff, but at least some of their qualification is covered by the government. So to subsidise the cost of that, the bigger businesses have to pay the apprentice levy, which is a small percentage of the wage bill. If your wage bill is over $3 million a year, then you have to pay the apprentice levy, which is then used to subsidise the cost of apprentices for smaller businesses that can't necessarily afford to pay to train their staff. So yeah, that's that. So value-added tax, VAT. I mean, this is probably the most contentious of all these taxes, because it's not a tax that comes out of it's not dependent on earnings. It's not something where you earn money and then the government take a percentage of the earnings. It is it's just added on to your sales, and then you can claim back what you spent on your purchases. So yeah, we've got a video on this, and it's quite a long one actually, because this is a very it's quite a wide-ranging subject, and it's quite a contentious one. So if you're running a business and you're over a certain threshold, you will be VAT registered. Sometimes people will voluntarily register even before they hit that threshold if they've got good reason. But yeah, it's a meaty subject, that. So have a look at the video on that. And then finally, for this list, this isn't a tax at all, but it's something that the government makes you pay now. It didn't used to be, but now since 2012, it has become not really a tax at all, but it's something you're obliged to pay, and therefore something you need to be mindful of. And the reason I've included it in this list is because this is a list of things that all, if not most, of our clients will be subject to. Auto-enrolment pensions came in 2012. Prior to that, it was up to the company whether they offered a pension. It was up to the company who they let in the pension. There was all kinds of things, like you had to be there for a certain amount of time before you'd be allowed to join the pension. You had to be at a certain level. Sometimes you'd have to be a certain level of employee before they'd let you join the pension. So now it's different. Every employer in the UK is obliged by law to offer an auto-enrolment pension scheme. So we will do a video on this because, again, it's an area that many of our clients are not sure about. It's something they leave to their accountant. And again, I don't really agree with that approach. I don't think you should leave too much to your accountant, because this is your business and your accountant is never going to take the same level of care as you are. So an auto-enrolment pension means you have to put people in it. You can't discourage them from joining it. You have to make it available, and you have to automatically enrol them when they meet certain criteria. So it's an important thing to be mindful of and be well aware of. And there's a lot of ins and outs and things, terminology that you should be aware of for that. So we're going to do a detailed video on that as well.